oh my gosh, everyone around me is a bear. Like, in other words, when he's researching or studying or whatever, or reading reports, whatever it is, he's like, oh my gosh, everyone's bearish. And so he makes this argument. He's like, oh no, I've been caught as a contrarian in a room of contrarians. And so the irony is like, wait a minute, if you're a bear because you thought you were contrarian, but everybody's a bear, are you really a contrarian? And it's this funny irony. And so we joke about it. But anyway, I guess as finance people, we think that's funny. But it's probably just a lame joke. But yeah, it is really interesting because there is a lot of bearish sentiment, especially amongst, I would say, people. I would say some of the people who are more prone to be bearish right now are actually, I would say, people who are above 40 years old. And that's not to be, how should I say, I'm not trying to be like ageist here, but I think that people above 40 years old who are bears right now are potentially bearish because they have that ingrained memory of how horrible 2008 was, or maybe even the dot-com era, or if you're older and you remember how terrible the late 70s and early 80s were in terms of recession, or even the S&L crisis, which a lot of people skip over when it comes to talking about Fed recessions and that. But you look at the savings and loan crisis and how terrible that, real estate crisis was in the late 80s, your 87, 88, 89, then you're very jaded to economic pain. And it wouldn't make sense that, quote unquote, words this time is different, that this time would be different. It just doesn't make sense. So when you look at how inverted the yield curve is, there is this complete explanation to say, look, I might not know what's going on, but I know how I felt in the past, and I know what the bond market is saying via the inverted yield curve, and this is bad. That's a strong argument that the bears have. And we're going to look at what Morgan Stanley's biggest bear, Mike Wilson, has to say in just a moment. But it is interesting that if history potentially jades older folks into being more bearish, then there is a real risk that they potentially just completely miss out on this recovery in the stock market, which would be quite disappointing, especially for those whom are older, because those who are older would likely have more of their retirement at risk, and so the risk of actually not being in the market might be substantially greater than trying to play the timing of it based on sort of this intuition, because quite frankly, the inverted yield curve, you could explain it away very quickly. And look, this is going to be a bear piece. We're going to look into Morgan Stanley's bear argument here, Mike Wilson's best bear argument. We're going to look at. But I want to say one thing before I talk about Morgan Stanley's best bear argument. Why would the yield curve be inverted? Well, the yield curve practically is inverted when the 2-year yield is higher than the 10-year yield, right? Why might that be? Well, what if the yield curve is actually so inverted? Because in this cycle, markets have actually come to believe that inflation will prove to be transitory. Well, if markets believe that inflation will prove to be transitory, then you're going to have high inflation for, this year, the last 12 months and the next 12 months, and you're going to be able to capitalize on higher bond yields. I should say you're going to demand higher bond yields. So in other words, you're not going to buy the 2-year bond unless you're getting compensated more because inflation is high. So the market is actually requiring higher compensation now because inflation is high now. But the market is willing to take lower compensation in the 10-year on a year-by-year basis because we expect inflation to go down. So ironically, you can yet again dismantle the inverted yield curve simply by making the argument that, well, of course, if inflation is going to be high for a couple years here and then lower in the future, of course people are going to buy the 2 years unless they have a higher nominal yield than the 10-year. Otherwise, yeah, anyway. So let's get into the bear piece. I don't want to belabor that too much. Let's get into Morgan Stanley's bear piece here. Let's see what's going on, what we have to say over here. So this is Morgan Stanley's biggest bear. It's Mr. Mike Wilson. I think he's smart, but I think he's so smart that he's buried himself into this bearish corner and he just can't get out. He just can't get out. So, what does he say this time? And I want to be clear when he published this. This was published the 11th, so yesterday evening-ish, since that was a G. Well, where would they be more? Whatever. Last week, we released our mid-year outlooks for strategy and economics. For U.S. equities, our key differentiated view now centers on our well below consensus earnings forecast for 2023, followed by a forecast for a sharp EPS recovery in 2024. Okay, so let me translate that to English because that was pretty ridiculous. So, in terms of like the language here, let's simplify this language. Morgan Stanley's biggest bear is telling you that the earnings recession in 2023 is going to be really painful, but then there's going to be this massive recovery in earnings per share next year. And now, what I've done yesterday is I've made this argument, and I want to compare that to what Morgan Stanley here says. I made this argument yesterday that you have three scenarios. The three scenarios are that either the Fed completely pauses and chills and eventually cuts rates, which is going to be great for stocks. That's the bullish argument. The base argument is that maybe the Fed's got another hike in it or two hikes in it. And quite frankly, even if the Fed has another hike or two in it, I think the market will probably just keep marching on. It's like, John Brown's body, the glory just keeps marching on, okay? And then there's the bear case, which is we go into recession, you have this earnings recession, and you have more job loss, in which case the Fed will likely cut rates anyway, which probably will also be bullish for markets because, well, just look at Germany. I suppose there is a fourth scenario, which is stagflation, which is where inflation runs hot, which disallows the Fed from cutting while you have an earnings recession. Okay, fine. That would be a potential fourth case. So, but again, we want to evaluate where is the inflation coming from to support stagflation. And right now, we're not seeing that. But let's keep listening here. So, what do we have here? Morgan Stanley's Mike Wilson says, for the past several years, our overarching view on the markets has been shaped by our hotter but shorter cycle framework. And this is basically where he's saying, like, hey, this cycle is going to be very similar to the World War II, the end of World War II, where basically what happened at the end of World War II was you had this really big buildup of excess savings. And because people had so much extra money, at the same time that manufacturers were focused on building guns instead of butter, right? Guns and butter, the old school version of that. Manufacturers were not able to basically fulfill orders as easily for goods, and there weren't as many laborers in the correct positions yet to fulfill services. So you had what was a post-World War II inflationary boom. And this post-World War II inflationary boom was seen as very similar to post-COVID. And what's interesting is post-COVID, listen to what Morgan Stanley suggests happens. He suggests that in each case, that is post-COVID and post-World War II, fundamentals and asset prices return to their prior cycle highs at a historically rapid pace. Now, the boom in inflation and earnings in 2021, which we forecast well in advance, eventually led the Fed to tighten policy at its fastest pace in 40 years. This boom and the Fed reaction proved surprising to many. Now, we suspect many will be surprised again by the depth of the earnings decline in 2023, as well as the subsequent rebound in 2024. So, in other words, he thinks that there's going to be this really short and rapid bust and then boom again. And that's because he thinks we're going to go from boom of 2021 to bust of 2023 and boom again in 2024. Somehow he thinks we're going to pendulum swing to the other side so very, very rapidly that this earnings recession is going to be so bad that you won't even want to be in stocks for it, but it's going to recover very rapidly, so be careful not to be in it. It's kind of a really weird argument. And I'll tell you, almost every time I read Morgan Stanley's Mike Wilson, I feel his bearish argument becoming weaker. I hate to say it, okay? But I mean, you can read the piece here. You've seen every word of this so far. We'll keep going here. But let's keep going. The boom bust period that began in 2020 is currently in the bust part of the earnings cycle, a dynamic that we believe has yet to be priced in during this bear market that began 18 months ago, and is largely related to just higher interest rates. In other words, margins and earnings will decline rapidly as inflation falls. So be careful what you wish for. Very interesting argument, because there's this argument that, hey, wait a minute. All y'all bulls want inflation to go down, but don't worry, when it does, oh boy, it's going to also kill earnings. Well, I'm going to talk about that in a moment in terms of where, but let's keep going. We think many investors are making two key assumptions that may be at risk. First, the impact of interest rates on growth is behind us. This is assumption number one. In other words, assumption number one is interest rates have already affected us. And assumption number two of the bulls is that several areas of the market, including consumer cyclicals, tech, and consumer communication services, have already had earnings recessions last year. I've actually mentioned this. I am a bull, and I have mentioned this. I have mentioned that we already had an earnings recession. You look at like Nike and the chips and stuff, you've already seen this. This is true, and therefore are likely to see accelerated earnings growth even as other parts of the market suffer. True. In fact, now this is Morgan Stanley responding, that reacceleration is now built into consensus. It's basically saying, yeah, but the market's already pricing in that rebound. In other words, you've got Morgan Stanley now responding with, we think this consensus view stems mostly from some large companies sounding more optimistic, and artificial intelligence, and what it means for both growth and productivity. While individual stocks will undoubtedly deliver accelerating growth from spending on AI, we do not think it will be enough to change the trajectory of the overall cyclical earnings trend in a meaningful way. Instead, it may pressure margins further. Oops, I put some charts in here. For companies who decide to invest in AI despite flat or decelerating top line growth in the near term. Okay, this is such an incredible mind twist of Mr. Bear here that we have to pause for a moment and think about what the hell he just said. He literally just said that some companies are going to spend money on artificial intelligence, and because they spend money investing in AI, they're actually going to end up having even worse earnings because they're going to waste money on AI and it's not going to work. Oh boy, you really have to be a bear to make that argument, don't you? Let me rephrase that one more time. Use the coupon code linked down below to always lock in Kevin's perspectives for life. Every day the market is open. We do our course member fundamental analysis together. We're applying artificial intelligence to all of the courses over the next month and a half here. So we're having a massive refresh. Next price increase expires and occurs on June 16th here. So we'll have a big expiration here on June 16th. That's just 4 days away. So buckle up. And we already got some amazing AI courses out or lectures out. Remember, we've got many different courses. We've got real estate investing, 0 to millionaire, stocks and psychology of money on the investing side. Then, of course, we have the income side. So you want to make more money as an employee or an entrepreneur, check that out as well. Okay, so with that said, think about what Morgan Stanley just argued, Mike Wilson. They made the argument that, okay, fine, artificial intelligence is actually hurting our bear thesis, but did you know there are going to be companies who are going to waste money on AI and it's not going to be very productive, and that's going to feed right back into the bearish narrative of an earnings recession and earnings falling. That's a pretty damn weak argument for a bear. I have to say, that's a very, very weak argument. I see what he's saying, but it's incredibly weak, okay? We note that earnings recessions over the past 70 years have often bottomed close to 17% in terms of earnings growth, the exact decline we're forecasting for 2023. This estimate is based on output from our earnings models, which capture the timing and magnitude of the deceleration in earnings growth we have seen so far in the cycle. The historical analysis suggests it's unlikely that the earnings recession will stop and reverse at its current levels, giving us the confidence in our estimates. Finally, earnings quality, as measured by net income to cash flow, recently reached its weakest level in the past 25 years. We see this as yet another warning sign that earnings growth will deteriorate further as the cycle turns and accounting policies reverse/are reset to more conservative assumptions. We further note that over-earning during the pandemic and the low quality of those earnings is broad-based. In other words, a lot of companies are going to have really bad comparisons to the last few years because they made money even though they probably weren't supposed to make money because everybody made money because of COVID. As we head into 2024, we see the market processing a much healthier earnings backdrop. And note that our 2024 earnings estimate growth is plus 23%. Okay, so he's so bearish, he's extremely bullish on 2024. This is so bizarre to me. I find it so bizarre that Morgan Stanley is holding on to this bear argument so strongly that they have to go as far as saying that, well, some companies are going to waste money on AI, man, and but don't worry, 2024 is going to be great. We're a bull in the long run, but it's just going to be bad in the short term. Okay, all right, Mr. Morgan. For investors who agree with our earnings path, they may decide to simply look through the downside this year. However, given where valuations are today, we think that is a risky strategy. This is him basically saying, look, we don't think you should be in stocks right now, and we think you should be careful for 2023. But in the long run, earnings are going to be great. So let me summarize the really horrible bear argument. The really horrible bear argument is, hey, you need to pick stocks because some stocks are going to waste their money on AI and some stocks aren't going to do enough or going to do well enough. In fact, remember right here, he says individual stocks will undoubtedly deliver accelerated growth, right? So some stocks are going to do great. A lot of stocks are going to do poorly. But in 2024, everything's going to go to the moon. That's the biggest bear argument on Wall Street right now. I don't think you can find. I mean, I'm sure. I mean, Jeffrey Gunlock is another big bear, but he's a bond market, technician, and I don't blame him for using the bond market to say, dude, the yield curve is so inverted. Just wait for it to reinvert. You're gonna have a massive recession. And that's probably the other bear argument that Morgan Stanley isn't even bringing up over here. Well, Mike Wilson at Morgan Stanley. Uh, but again, a lot of that inverted yield curve can be explained away by, of course, if we're going to have high inflation for 2022 and 2023 and maybe into 2024, you're going to demand a higher yield on your 2-year. Because why would you put a dime into a 2-year bond if the 10-year will compensate you more? You wouldn't. So you wouldn't buy the 10-year, or sorry, you wouldn't buy the 2-year until the yield is higher because inflation is high right now. Which means when people don't buy a bond, the yield goes up. And then the yield rises to the point where people actually start buying it. So it's quite remarkable when we consider that this is supposed to be one of the biggest bears on Wall Street, and it's just not looking good. And then of course we have Commodity Steve, a fellow Canadian, suggesting that lithium will still be in high demand. So remember to check out your rocks. And he's not wrong. Lithium will absolutely still be in high demand. I agree with that. Let's see here. Second wave. Okay, and then Steve does reiterate this part of the bear narrative, which is that the second wave of inflation is going to come due to a reduction of capex spending on future growth across multiple sectors. Are you suggesting a decline in productivity? That's an interesting argument. A second wave of inflation is going to come due to a reduction of capex spend on future growth. Well, if you don't invest into future growth, you're basically reducing your future productivity. Look, I would argue, and I think this applies to both what Steve is saying and what Mike Wilson is saying. I would make the argument that you really are going to see some companies suffer. I believe, and I've believed this for a very long period of time, probably about 8 months, that the consumer staples have had their run. Okay, they had their safety run at the beginning of 2022. They had their lingering price increases, but the days of Coca-Cola, Walmart, McDonald's, Target, Costco, the days of these staples, Home Depot, Lowe's, Kimberly-Clark, Procter& and Gamble, 3M, the days of the staples are over. Walgreens, the staples are done. Honestly, most of them have been on a downtrend for the last 6-7 months. They've sat out the tech rally, and so now I'm a little weirded out because 6-7 months ago I was basically all in on chips and tech, but now chips and tech have run so much to where the peg ratios are starting to get out of whack again. I like to buy with a peg around like 1.6, 1.7. Tesla's above that now. The chip companies are all above that now. Although, it remains to be seen what the actual growth will be of these chip companies. That's the other question, is like, how do you calculate earnings growth when what's driving growth keeps changing? And so there's this question like, well, is artificial intelligence spending just going to create one cycle of massive revenue for a company like Nvidia? Or is this going to be, multiple years of adjusted revenue up? Who knows? Stephen Mike sitting in a tree. Kissing. Oh my God. Kindergarten's in the house here. Okay. I'm suggesting that companies are not investing in their future because of the high cost of capital, i.e., supply will not increase in the future. Okay, yeah. So that's actually an interesting argument, that because it's so expensive to basically access working capital right now, it might make less sense to invest in machinery or whatever going forward. I think, as a counter argument, I think you might be slightly over evaluating how much interest spend affects some of the larger drivers of innovation today. I think that most of the large companies today that are really driving productivity see interest expenses as a really nominal sort of footnote on their income statement. It would be worth looking at each company individually. Like, I don't think that's true for cruise lines, right? For cruise lines, interest expense is massive. For a company like Disney, interest expenses is a massive expense. But then when you look at a company like Apple, or some of the other technology companies, interest expense is relatively nominal, to where it would be interesting to look at the manufacturers, though. Maybe look at like a TSM, right? How much does interest really affect them? I'm not entirely convinced that the drivers there are not going to double down on investment.